across our agencies, hiring intent did drop. From last year, 69% were planning on hiring, now 40%. So we've almost gone to a period where there's almost a hiring freeze across agencies during this period of uncertainty until they work out what the future looks like. 47% saying a challenge was competing in a crowded market, hence that feeling about, people are fighting for potentially a smaller pool of work, but they feel like competition is fierce. And that's just part of being an agency. The barrier to entry to being an agency is zero. You can just whack up a website and say you are. So it is a crowded market and it's hard to stand out. And the third data point was that utilisation had gone up. So hopefully the participants listened to me last year and have started to track time and utilisation and take that more seriously, and the operational side of the business. So those are some other interesting data points with that change in mood.
Michael, just a quick question on that utilisation. Is every one of your clients still billing on an hourly basis, or are you seeing people charge by outcome?
I've got a couple slides on that later in the talk. High level, people are moving away from billing by the hour 100% to outcome, and that's where the future's going. Mm-hmm. At the very least, even if a lot of business models that are built on hours charge out rates, at the very least for my clients, I'm like, remove that from your quotes. Do not give that to your client as a potential point to negotiate, and just have a flat number. We don't need to tell them how the sausage is made, because, the value of time is up for debate at the moment with the current tools and people questioning how long it really is taking you. So we do have a section on that, which will be interesting to look at in a sec.
Yeah.
So our view is you can't change the wind, but you can trim your sails and adjust to those conditions. And I think that's what the smart agencies are doing right now, is reading the wind, reading the market, and then trying to optimize their business for the future. So let's quickly dive into the scoreboard, give you some key stats from the survey. Agency profitability is the headline. The biggest pool of people across the 125 agencies were sitting in that 11 to 20% net profit. I would argue like a healthy benchmark to aim for is 20% plus, ideally. And so you can see that, the majority were knocking on the door, but not quite there. And 28%, or, almost a third there, are still in that 0 to 10% net profit. Well, yeah, if you're below zero, you take the unprofitable, that's 30% of the participants. That is, if you're in that range, 0 to 10% net profit, that would be the number one critical challenge I'd be working on this year, is to fix our margin, to give us a little bit more cash, to give us some more options. Because if you're consistently operating in that level, it doesn't take much to blow you off course, and a couple of lost clients or a couple of big unforeseen things, you can be really in emergency situation very quickly. So good to see everyone knocking on the door of 20, but obviously we want as many agencies as possible north of 20%. So that was the first data point I thought was interesting. And that's exactly said. Yeah, I've already mentioned that. When we dove into what the 20% plus cohort were doing, so we kind of analysed what the top performers were doing in the data, they all had their operations under control. That wasn't a stress point, so they were focused on that efficiency stuff. They were capturing AI as margin, and we'll show you that graph in a sec, but they were using that to drive more profits right now. They were paying their founder properly, a market-based wage ran through the business, through the P&L. And interestingly, they were confident and still hiring, whilst others were freezing. So they were more likely to be in that, yes, I'm still hiring, which, if you're 20% plus margins, gives you the luxury of being able to do that. You can take a bit of a hit to your margin to hire because you're operating from a higher level to begin with. But if you're at 8% net profit and you hire a salesperson, that might wipe out a big chunk of your margin. So those people were confident, paying themselves properly, so they knew their business model and they were running their operations efficiently. So this is going to try and look at the common leaks or profit leaks across it, and maybe you might resonate with a couple of these, and hopefully you might pick up a tip or two. So the number one is you can't fix a number you can't see honestly, and that's your own wage. So 68% of people were paying themselves a market-based wage through the business, but there was still 32% who were not paying themselves a market-based wage through the business. So it's now the standard, not the exception, but often this is a grey area about what market rate might be. I know, Ryan, maybe you probably have better data on this than me about what a founder should be, but I commonly see founders still putting something through the P&L, but they might still be underpaying themselves slightly, compared to what they're actually doing in the business.
And we had this, we were chatting about this earlier, and I think you sort of said, it starts around that, 150-ish mark as a market rate wage. And that, to me, that was quite surprising, in a sense that, I place candidates into roles where obviously they don't have that stress of running a business, and they're earning, sometimes more than that. So I think it's very difficult to say what a founder should be. It's obviously based on the size of the business, the turnover, and everything like that. But yeah, I guess I just want people to be aware of, like, it's a lot of work that you're all doing to run a business, and make sure you're getting rightfully paid for it, because at the end of the day, what are you doing it for otherwise?
Yeah, for sure. And I commonly see people discounting, say if they bring on a GM or a head of sales, they're like, you know what, I'm going to build myself out of the business. I'll take a bit of a hit, but I'm getting more freedom in the short term. That's great and that's fine cash flow wise, but you still want the business model to feel the effects of what a full paid management team would, because otherwise you'll never build yourself out, because the business model's never had to feel what it's like with those bigger wages at the top. Cool. And then if you're underpaying yourself, you might say that you're a 20% agency, but in reality, if you're patting yourself 100 grand versus 250K, your actual profit margin might be below 10%, might be 5%. So you're kind of lying to yourself how profitable your agency is, because you're not recognizing one of the biggest costs to the business. So obviously tips here are pay yourself a market-based wage. What would you pay someone like a GM or, a second in command to do what you do? What would that market wage be if you literally wanted to build yourself out completely and hand it over to someone? That's where the number needs to be at a minimum. And then have a look. If you're not doing this, look at last quarter's P&L, throw that number in, and then have a look at what your true net profit is. And if that's a scary number, then that's what I'd focus on to fix.
Michael, just quick question on that, and just an observation that I've made with founders looking to bring in a GM or someone. Like, I think it's often a frustration for founders that are just feeling almost burnt out and overworked with every aspect of the role. You're responsible for sales, the people, and I think that it's often I just need to get out of this situation, and I'm going to bring in someone to take over that responsibility. But I've seen it go wrong far more often than it goes right. So it's something to just take into consideration, that, in my opinion, the GM doesn't fix everything. I think it's a part of it, and I think it's a lot to unpack before making that high level hire. So yeah, if anyone is in that position and wants to sort of pick my brain on that, then would love to give some thoughts on that.
For sure. It's an expensive hire to make if it doesn't go well, and they're only operating in the systems that you train them on. So if you hire them expecting them to solve the fact that you haven't got dialed in systems, then that's an unfair ask. So yeah, I do see that as well. Great. Next one is pricing under pressure. Profit leak number 2. And so here's what the data is telling us around pricing. High level, and we saw this in last year's survey too, 2 agencies could state on the survey response, we're doing 190 an hour charge out rate or 250 or whatever they think they're doing. But one was actually profitable, 20%, and the other less than. So it tells you that charge out rates aren't the only data point you need to look at, because margin is won or lost after the contract is signed, and overservicing is endemic in agency land to keep the client or impress them. So, take these charge out rates with a grain of salt. It's about how you deliver that work. Is that in reality your charge out rate? So 94% are feeling pricing pressure, varying from mild at 50% of the survey respondents to moderate, and then 16% were feeling a high pricing pressure. But interestingly, 54% had raised their prices in the last 12 months, and another 20% 21% had planned to. So if you're not going to be raising them, you're in the minority, even though there is pricing pressure out there. So I'm reading this as it's more competitive. You need to demonstrate your value even more. And so you need to be better and good at what you do in order to justify that price increase. And team members need it. Cost of living, if you want to give your team member a pay rise, it needs to come from somewhere. And that's the price increase.
Michael, I guess, putting myself in the shoes of an agency owner right now, like, how do you best communicate that with your clients, do you think, around that price increase? Because it's always a bit of an uncomfortable email or conversation, but yeah, how would you go about it?
There's a few ways to do it. The easiest tip I can give you is build it into your contracts that there's a CPI increase every year, like CPI or 5%, just at the 12-month mark. So that just happens automatically. And so you already have a little bit of margin built in there that you can do, rather than avoiding the conversation for 4 years and then hiking them with the 20%. That hurts. So small regular increments already built in. The other way that we do it is you don't do it on everyone, you do it on the most unprofitable clients at the start, and only do it once you've got a good, strong pipeline. So if they balk at the price, you can replace them with a more profitable one. So you de-risk how you do this. This isn't a scary email blast to all of your clients at once. That is a suicide mission, and you might have a massive churn event. So you've got to be tactical about how you do this when you roll it out. And it's kind of a case-by-case ability, but yeah, the more warning you can give them. And I always say, don't overthink it. Be honest. Hey, we've had to give our pay increase. Everything in our business is going up. We're going to work harder, and often people will respect that. And the last one I'll give you is, sometimes people completely repackage what they offer to disguise the fact that they're taking out some parts of their offer that are time suck and not profitable. So, for a lot of agencies, like social can be a time suck, and, they don't make a lot of margin on, so they might rejig what they offer, take that out, and just focus on the profitable stuff they know they can deliver. Okay, great. So these are the charge out rates. As I said, take them with a grain of salt, but 36%, majority of people are $200 an hour or above, which is great. And then the next biggest is knocking on the door of 180 to 200. So that's great. That was an improvement from last year's. So we are, as a weighted average charge out rate, going up the value curve, which is good. But it does depend on actually if you can deliver in those budgeted hours as to whether that is your charge out rate.
Michael, is that across all different services, or is that more of a senior charge out rate, or what is that?
Yeah, we didn't go in terms of the survey questions. We didn't ask per tiered experience level. This was more just an agency-wide charge out rate. We try to keep it as general as possible.
Yeah.
For my clients, we advocate for tiered, so it's not just one for everyone. The seniors are on a much more expensive one. Juniors, probably closer to this. So it's just this was, I guess, a harder one to go into super granular detail, because every agency has different levels and different stuff like that. So this is just a general number.
Mm-hmm.
And I'm sure you guys are aware of this, but like, pricing is the fastest profit lever. If you're struggling for cash, if you can increase your prices across your list or on certain clients, majority of that cash drops to your bottom line in net profit, which is fantastic as long as you keep the team the same and you're delivering the same service. So that's why price rises are the most appealing. But doing them, justifying them, are you good enough to it? It's that's the bigger question there. And in terms of charge out rates, just a little tip: make sure you're not bleeding money on them. Obviously, you want to charge as much as possible and increase your prices and have nice chunky retainers. But this is an example of how you would break out your tiered charge out rates. You'd have a look at your different levels of wage across the business, work out what their fully loaded cost per hour is, including super and all that. And then your floor for that person, so your minimum charge out rate, should be times 3.5 what their cost is to the business, and ideally times 4 or above, depending on what you can get away with. So that's to make sure you're not bleeding money and setting that. So that's kind of and the number one thing we see is that the seniors aren't being charged out high enough, and they're costing us money because they're often the most expensive in the business, and they're not properly utilized, and they're not properly utilized at the right number as well. So I check them first if you're looking at trying to find a bit of margin in your business today. This is trying to tie together more competitive landscape. AI is having an impact, crowded market. So obviously dropping your price if you're in a cash crunch is appealing. But I think the smarter agencies are holding their price or increasing it, but adding more value and actually increasing the quality of their offer, because that's a race to the bottom you don't want to be in, and you won't be able to pull out of a death spiral if you keep reducing your value to the market. You become an order taker, and that's not a position of power. Here's a little case study of a client I currently help. They deal with big brands you would have heard of, but the brands dictate the charge out rate. They're like, no, you can't charge above X per hour for certain things, certain roles. And here it is. So they have all the power because they know they're a big brand that everyone wants to work with. So the only two levers we have to play with here is like quote a certain hourly rate and just do it in less hours. So find more efficiency. But for this agency, that will result in less quality. Like, we want our output to be great. We want our output to win awards. So doing it unless it's just going to hurt, and then the client won't like it anyway. And then the other one is, all right, well, if we can't do that, we need to do it with juniors who cost us less and make a bit of margin that way because the charge out rate is set. But both are risking quality of the output for this agency. So we're kind of in a tricky situation where we want the job, but they're dictating a price cap, and they'll go somewhere else because it's a competitive market. So we're at the moment trying to work out, what do we do? Because we need to do more with less. We need to maintain the quality, but we need to find margin somewhere. And this is the kind of, competitive landscape that is happening at the moment. Is you don't want to overservice this. And traditionally what our agency would do is just say yes, service it with the seniors and make no money on it. But they've still got the big brand, so they're happy with it. But that big brand is costing them money. And I see that a lot with agencies' whale clients, is that they actually aren't making much money at all on their biggest clients. So that's a good example of the challenges currently facing agencies and how you can go about trying to get better and find efficiencies. And I know it sounds like corporate jargon, but that's the reality of what people are having to do now. Our take on this, with all of this pressure around, is clients aren't buying hours, they're buying judgment, diagnosis, the credibility of external advice. So setting that minimum charge out rate stops the bleeding, make sure you're not losing money. But ideally, you want to be priced on your output, on the value you're bringing, the holy grail of value-based pricing. So being able to articulate your value to the market and prove it with case studies, I think will help future-proof it. And anything that you're not making 50% gross margin on in terms of client, they're probably not a great long-term fit anyway. So, I had this conversation on a client call this morning. Like a bad person with AIs, it's just like a more leveraged slot. Whereas an agency with taste and discernment and experience using those tools has an upwardly massive positive effect. So there's still space for agencies out there, but it's how you're using the tools that separates you. It's a quick win for you here. Which clients haven't had a price increase in 12 months? I'd have a look at them and see about how you can add more value or go about having a conversation with them. And then if not, build it into your future annual contracts, little 5% rise to at least keep you up with inflation. Cool. AI, this was very, very hot, it still is, but very, very hot topic at the time we were doing the survey in March, April. So we had a new section this year just on AI. What happens to an agency when AI saves you time? 45% were adding more value, but 43% were keeping the fee the same and pocketing the gains. So they were getting more efficient and making more money off the back because they could take on more clients. And that was, I think, where a lot of smart players are at the moment, kind of holding the line as long as possible until pricing pressure comes. And 5%, interestingly, we're reducing fees. And as I said earlier, that's a race to the bottom. I wouldn't be doing that at all if you can't. So it's great that AI, people are pocketing the dividend at the moment. Interestingly, though, the pricing models haven't changed. So the old pricing model that you used to use about how service business works, people are still just running that playbook. But not that many are switching to outcome-based or value-based at the moment, 4%. Some 10% shift to fixed fee. But when we ask this next year, I'll be interested to see if that grows and people realize they can't keep doing the old model of hours and charge out rate, because it creates more questions than it does, and you have to justify it a lot more. And I think, the 43% keeping the margin won't hold that forever. And I'm already seeing pricing pressure across a few different areas, like websites is an obvious common one that people are starting to question. Some of my clients are still selling decent price for bigger websites, but the volume of those coming through is less. So I think they'll be, depending on what kind of agency you are, what your offering is, it'll play out. It won't be even to start in terms of how that pricing pressure comes. This is kind of digging into that hiring pause I mentioned at the top. So 52% have got them on hold. And then who they're hiring less of, fewer juniors and contractors, as AI is doing some of the grunt work. But I'm seeing this across my clients and in the survey data is good people are harder to find. And that's my point earlier. It leverages who you hire, good or bad, because as a service business, your people are your product. And so if you've got a dialed in process and great people, obviously you're in a stronger position. Are you seeing any difference in hiring at the moment, Ryan? Across, obviously, you've got way more market data on that than me.
Yeah, look, I think there was definitely a point where I thought that, from a recruitment perspective, we were going to be massively affected. But I think what's happened and I'm actually often speaking to founders saying, I don't necessarily think adding a headcount is the right answer, but I think that where our value comes in and why we're probably having a good run at the moment is that whilst the volume of hiring is down, I think there's an even bigger need to make sure that the quality is there. I think a lot of agencies historically have had quite bloated teams and been quite headcount focused, whereas now I think with all of the tools at our disposal, I think that more can be done with less, but you just need to make sure that those people are A players. So yes, I think the volume is down, but I think the need for quality has gone up.
Yes, yeah, I fully agree. It's made it way more important who's on your team, because they have a bigger impact, good or bad.
Yeah, I think as well, Michael, and maybe get your thoughts on this, is that I think by nature, founders are built a certain way in terms of their strengths and skills. And I think that for me, the founders that do the best find someone that complements their blind spots or their weaknesses. And it's often, the operations side of things. And I think, I think that's a real smart play to have someone, and I think we're in a period at the moment when it comes to operations that businesses are thinking that AI is going to replace the need for that glue that binds everything together. But I think it's a bit of I don't think that's necessarily accurate. And I think we will see a surge in businesses bringing back operations and investing in this. Whilst it may not be a revenue generator, it is in the sense that it makes things more efficient. So I think businesses are more productive when they do have a good operations person in place.
Yeah, for sure. Absolutely. And like my best clients and the founder who is the least stressed, they've got dialed in clear systems and processes, and that operational piece is tied in, which also is reflected in the data that the people more likely to be in 20% plus net profit have that dialed in. So I think it's a critical differentiator. You can throw AI at anything, but if it's in the right system, obviously you're going to get better impact.
Michael, in terms of systems that you're seeing popular, I mean, I'm sure there's so many out there, but is there a system or a platform that you're seeing being really effective at at the tracking of all of this?
There's no one software to rule them all. We ask a software question in this survey data, and there's a bunch out there in terms of workflow management solutions and softwares to map time, plan resourcing. Productive is one, Acello. There's you name it. There's so many out there that could do that for you. It's just a tool, and you've got to have the thinking and the structure and the accountability behind it for people to use it accurately. Make it simple enough for people to use, follow up accountability wise, have meetings about it when you're on track or off track. So it's not so much the tool, because we'll look at time tracking data in a sec, but it's how people are using that tool, which, as you said, if you've got someone driving operations inside the business, it's going to be used a lot better. So yeah, there's no magic bullet with buy this software and you will be thing. A lot of this is a human problem, which is using it.
Yeah, for sure.
Cool. So, spoke a lot about AI, but basically we're seeing our clients move more to outcome-based or fixed fee, stripping out the hours and the charge out rates and just delivering on outcomes where possible. And then some tips for you. Pick your top service, have a look at your delivery hours. Are you saving any time at the moment, or is it just going into another bucket, and is it just a shiny object for you? And ideally, you're getting more efficient and the team are getting more efficient, and you can bank that margin, or your team can take on more clients because you are genuinely saving time. And then fix the outcome, switch to fixed fee or outcome to get ahead of that pricing conversation that's going to come. Cool. This one is on below deck, the engine room. So this kind of goes back to the pricing charge out rate question. You're often not undercharging, you're just overservicing. And then the simple math of how many hours it takes you is bringing your profit margins down. So great, really positive data point from this year's survey is that utilisation tracking is up. And across the utilisation data, 41% are tracking time and trust the data. And this has got to do with the input problem, Ryan, of are the humans putting it in correctly for us to even use the data? And then 35% are tracking it but don't trust it. So they're going through the work of having to hound people and everyone's going through the motions, but they can't make clear decisions on it because they believe that there's inconsistencies in it. So there's porcupines happening. And then 24% of respondents still don't track it. So if you're in that category, I would advocate for you to think about it, even just with a small section to start, because that's where money is walking out the door. Wages is your most expensive line on the P&L for an agency, and you are buying hours off your team. But if you don't know where those hours are being spent, how do you know if they're productive and you're making any margin on it? So that's my kind of spiel for doing it, and great to see a lot of people are. But ideally, that 35% who don't trust it can move and have that honest conversation to start believing in the data. And that's the bigger challenge there, is not just implementing it, but getting honesty in the system. And then the metric to use if you're in one of those buckets where you are doing it, utilization itself is kind of a flawed metric, because you could be spending 100% of your week on a client that's giving the company $100, and that's a massively unprofitable client, right? So if you're fully utilized, but it needs to be utilized on profitable clients. So we use something called effective hourly rate for our clients, or average billable rate. And that's just taking the total dollars a client gives us per month and dividing it by the total hours we're spending on that client. Very simple calc, but across all your clients, across month by month tracking. And that'll show you how much you're actually making in terms of a charge out rate versus what you're putting on your quotes and what you think you're quoting out at. If you think you're a $250 or $300 an hour, this will tell you actually how efficient you are. So you got to make sure you're actually getting a sense check. And this is the power of time tracking data, is having a look at client profitability. So definitely one to think about if you're not doing this. And that's my point here. And in the data backs this up, is that the agencies above 20% profit are more likely to be tracking it and trusting it. So they're the ones with that clear read of where their company's time is going, where their team members' time is going. So if you're not, select a team, just do 1 week or do a sample size just to see if you're on track or off track. And this is a sensitive one to roll out, but It's about client profitability and stopping teams from overservicing clients and burning themselves out, which I have seen before. People overservicing and these wasted hours, and they're burnt out from it as well. It's not about like Big Brother surveilling any one team member's time. It's about protecting them. And then in terms of utilization goals, 75% of a doer or a technician's time a week ideally is on billable work. And then it's a tricky balance. Management are less than that. There's a few different ways you can slice it, but that's a rough goal to aim for. Okay, cool. So the healthy cohort, just to recap what the agencies in Australia who are 20% or above, they're paying themselves first. So they've got an honest assessment of their P&L with a market-based wage in there. They've got a good idea of what their floor is in terms of charge out rate and pricing, and they're not going below it, and making sure that that's a fair price for what they're delivering. They're also pocketing the AI gain. So they're repricing and getting that margin and reinvesting it now before the pricing pressure comes. And I'm really interested to see when we run this next year, how that pricing pressure question changes over time as well. And then track your effective hourly rate or your billable rate in reality using that time tracking data, and don't just rely on utilization, which is it's one indicator, but it's flawed just looking at that on its own. So you can't change the wind, but you can read it and adapt. And hopefully, all of you after turning up today have got maybe one or two ideas that you can do to help adapt to this more competitive environment. My gift, if you want to have a look at the actual full report that we have released recently, scan the QR code on the screen there and you'll be able to download it. It's got a bunch of stuff in there in more detail than I've gone through here, and it might give you some ideas about how to do it. And hopefully, if you got value, you'd be part of the survey next year. We'll launch it early next year, and we're going to try and do this every year, as a great way to bring Aussie agencies and New Zealand agencies together to help them and help them get a sense check for how they're feeling and comparing across the market. So, yeah, feel free to scan that and have a read, and hopefully it helps you improve your business. And that's it. That's the final one. If you want to hit me up, I'm on LinkedIn. I try and post there, a few times a week. So I'm always on there if you want to send me a message, or you can get in touch at trimline.co.co. That's our website.
Awesome, mate. That was awesome. Really good. But I guess I've got some broad questions, and please, anyone, feel free to shoot in there. But Michael, I guess in terms of what you're seeing with the agencies performing well at the moment, would you say all of them or some of them are, marketing themselves? Like how are they kind of putting themselves in the way of opportunities, would you say?
Like from a pure sales and marketing lens, or what do you?
I guess having dealt with different agencies and you're seeing some having various degrees of success, like is there any sort of not secret sauce? Like what do you think that if you could advise on a very top level, they're doing very well, would you say?
It really depends on the agency and who their target market is and what game they're playing in. But the top performers, generally the founder will have more time to work on the business. So they do have time to think about strategy. They're not stuck in firefighting to give them that edge to look at what's coming ahead. And as a result, they're able to play with AI tools way more and try and find efficiencies and actually work out what's coming down the line and think about that stuff. And I think I say it in more depth in the report. The summary is like the competitive advantage now is having the time and space to play with all this new tech and getting a read of what's actually coming down the line and what this means for the bigger picture. You don't want to be a founder stuck in the weeds right now because you don't know which way your car's driving, and you might be driving to a cliff, but you're too busy even in delivery to think about it until it's too late. So having time and space to do that, I think, is a common one. But that comes with having more margins, and it's kind of like you got to stack all those things up together to get that freedom to do it.
Yeah. I was speaking to someone yesterday about this, and I think that the nature of the inquiry, so if a client is coming to the agency based on they've seen their work or they've seen there's a bit of a buzz about them, I feel like that can often, that's a very different conversation to say the agency going after the client and trying to pitch for work, right? So, and that's where I think a lot of agencies get caught in that price game of they want to win the work, but because you're chasing or trying to go after the client, they have the power. But the power, as soon as the power shifts to them coming to you based on reputation and credibility in the market, that's where I think there's a bit more fat in the price to play with, because that they've come to you.
I had an awards conversation with a client this morning, and my take on awards, they're kind of like a necessary evil. A lot of people grunt and groan, they're expensive, but especially if you're a more creative shop, they're almost like they have an outsized impact on your rep in the market, like you said. So I think those kind of creative agencies, it really does help. The different target markets, it may not impact it as much, but it's a tricky one. I know a lot of agencies do use the award strategy as a way to try and build that rep, and it's just a matter of what your priorities are, because marketing budget dollars are limited, and it's about investing. Like, I always advise agencies to be spending, between, at a minimum, 3 to 7% of their revenue on marketing in some way. So that could be awards entries, that could be paid ads, that could be events, whatever, that would, depending on your target market. But that's like, as a minimum, you should be placing some bets in those areas to help fund that future growth.
Absolutely, for sure. And I think that, I've said this many times, but if you are looking at hiring a marketer or an ops person, you don't need to go full time if that doesn't suit your budget, right? You can definitely find value in a fractional person to come in and do that and kind of get the runs on the board before bringing it on as a full-time hire. But I think that an agency to flourish, if they're not marketing themselves or promoting themselves, then you're going to find yourself in a price battle far too often, I think.
Yeah. And that was another data point in the survey that's not in this report, I don't think, but everyone's working harder on marketing. That's a bigger part of the takeaways, is that everyone's doubling down on it because they're feeling that pressure, and they're feeling the pricing pressure, and churn has ticked up for a lot of my clients as well. There's, some of my bigger agencies, dealing with a lot of churn because they're exposed to a wider subsection of the economy. And so they're having to run faster to drive leads just to cover the gap. So, it's not a one size fits all, but you have to constantly be doing it. It's a necessary evil of being a founder and being in business.
Sure. Well, not to put you on the spot here, but you mentioned earlier around agencies needing to add more value versus reduce it, right? What's a really easy or good example, would you say, of an agency delivering value outside of just fulfilling the work that's been asked of them?
I mean, the obvious one is suggesting new tools or better ways to do the existing process. So coming to them with a better, quicker, faster system that will get them more results. So showing that you're testing stuff and know what's happening out there. That would be an obvious one to show that you're being proactive in the relationship, or offering them different ways to look at it. You've developed your own internal tool and it's an upsell, and they can see that you're staying one step ahead with the tech. So some sort of proactivity, I think, in whatever way you can do that, I think would probably be one example.
Yeah, awesome. If anyone has any questions, please feel free to shoot through. We've got a few minutes before we wrap up. Michael, are you optimistic about the next year or two for agency owners, do you think?
I think if you're a good operator, more challenging times gives you more opportunity. So I think the substandard shops that are just hacky and they're trying to collect a few dollars and that kind of stuff, the founder's not fully committed to the craft, I think it'll be a bad time for them. But I think if they're on this webinar thinking about improving their agency, invested in it, spending time on things like this, I think it's a good sign that they do want to get better. And I think there'll be more opportunity for those people in the long run. What's that old quote? I think it's a Buffett quote about like rising tide lifts all boats, but only when the tide goes out do you see who's wearing pants. And so
Mm.
in more challenging environments, people get exposed as to, is your quality and level there? So I think that's why people are working harder and feeling all of those pressures, is that everyone's having to up their level. So it's more competitive, but I think that'll ultimately create better businesses.
Absolutely. And do you see opportunities with agencies collaborating with other agencies? Is that something you come across when it comes to sharing of clients and resources and things?
Yeah, that's a massively underutilized one in the marketing space for sure. That's one of their biggest drivers is partnerships across, building alliances across non-competing agencies, for sure. But it just depends on the success of that agency, right? If you've got a certain list of partners you deal with, and they're struggling, they're not going to send you many referrals. So keeping on building new partnerships is also part of the game, because the lead sources do dry up. But yeah, that is a, and it's often the lowest cost one. You don't have to
Yeah.
invest in paid ads for that one. It's just the founder's time to build that relationship,
Yeah.
making it a win-win. So yeah, 100%, that's a great one.
I think one thing we've seen a lot this year is the example I use the most is that more traditional creative agencies who perhaps have never done performance marketing before, who are thinking about building that as a capability. And what we've done for a lot of agencies is provide a fractional operator to essentially come in as a one person agency who are highly experienced, run like their own business, and they kind of plug in to start offering it as a service to then almost test the demand for it. And I think that's a really smart play if you're going into a new area, rather than paying premium for somebody to come in, when that could be a very costly mistake if you don't have that sort of viability proven.
Definitely. It's a risk. And especially if the founder doesn't know it. So they don't even know what good looks like. Like if you're a founder with that technical skill, it'll be easy to hire and know what good looks like. But if it's a new area that you don't know, you're not across, it's a blind spot for you. So hiring someone with that established experience is definitely a good way to test the waters for sure.
I've got a question from Caleb. If we're selling clients on outcomes rather than hours, but tracking teams' outputs on hours, any strategies to increase pricing whilst holding true to the outcomes agreement?
So we're tracking selling on outcomes, a set price. Yep. Tracking teams out. So the tracking teams hours is to make sure we're not blowing out jobs, but ideally we're doing it in a quicker amount of time. So can you get to the question of that? He's saying any strategies to increase prices whilst holding true to the outcomes agreement. So does he mean not increasing the outcomes price point?
Yeah, I'm not sure, Caleb. You might need to. Yeah, I'm a bit lost on that one, but yeah, any strategies to increase pricing while holding true to the outcome? Yeah, look, I think there's probably a two sides to that. I think the internal operations where you're tracking hours is something that will still need to be happening. But I think the conversation with your client needs to
Yeah.
move away from that and start kind of pitching the outcome. And I think for the first time I've seen, when I'm speaking to candidates, where I've typically asked, what's your, and this is probably at the more senior end of, what's your hourly or daily rate? They've gone, I don't charge by that, I charge by outcome, which I think is always a start of, okay, well, they can do that because they're at the premium end of town, but that I think will inevitably filter down and become, or hopefully should be, more viable. But I think if I think about the psychology behind that, is you have to be in a position of being a premium and people coming to you to be able to charge that outcome. And I think that links back to then having that brand presence where people are coming to you and desiring your services, rather than you trying to just get them at the best price.
Yeah. The hourly charging and the hourly tracking is to sense check we're not blowing out and then we're on track. But the sky's the limit in terms of obviously what we could charge to the client. There's the two different goals for that, to make sure we're still on track. That's the main thing with time tracking for me is, are we on track or off track? Are we blowing out in any areas? and does that need another pricing conversation?
Awesome. Mike, I think you mentioned, so if anyone, is looking to, engage with you, it's a conversation, and then sort of do a bit of a needs analysis. And then is that how it works with yourself?
Yeah. So I plug in and help agencies at that 1 mil revenue and above is the kind of the main entry point. And usually it will involve just a quick 15-minute chat to see if it's a good fit, see if there's a problem that's solvable, and make sure it's kind of, it could be a win-win. And then from there, we have a second conversation, and they learn a bit more about how we work and that kind of stuff in the monthly cycle. And if it works, it works. If it doesn't, it doesn't. I try and help them regardless with the time we're together.
Awesome. Michael, I've really enjoyed the chat. I really appreciate your time. And yeah, look, I think we've got to be optimistic. And as your results show, I think founders, and we have to put that optimism hat on. But I think having, and I can speak from experience here, from having a CFO joining our business, that I think it just gives that rigor, it gives that accountability piece, and I think it just makes you feel more at ease rather than and having that visibility. So, if anyone is thinking about bringing in a CFO, like I can highly recommend from my own experience, and I think it just makes your business more structured. So yeah, it's good. Michael, when's your next survey out? Is that next year? Will that be, or?
Yeah. It'll be next year. So we launch it at the start of every new year, and kind of so it'll be probably Feb, March, April again next year. We'll be running it. So if you download that QR code or the link there to get this year's report, we will obviously get in touch with you once we're launching the new one. And the more people are a part of it, the better the data set is, the more we can trust the answers. And we're working hard to make it super valuable for people who are actually part of it. We've given them all of the questions and all of the graphs graphed out this year as a separate bonus slide deck for them. And we're also giving them early access to it. So we're trying to make it a valuable thing for people to be part of every year. It's not just like a shitty lead magnet that's meant to collect your email. We're trying to invest a lot of time to make this a useful exercise for everyone.
Yeah. And Michael, I appreciate all the prep you went in for today's session. So look, everyone, good luck for the new financial year. Keep optimistic, keep doing what you're doing, and hopefully take some of the takeaways from today. And Michael, we'll do it again next year, shall we?
Yeah, looking forward to it. Thanks for having me, Ryan. I appreciate it.
Awesome. All right. Thanks, mate. Cheers.
Cheers, guys.